Hello and welcome to TheoTrade. My name is Doc Severson and this is the Theo Night Report for Tuesday, August 16th. Alright, the topic for tonight's video is we're looking at a daily chart of the S&P, and I've got about 20 years of data queued up here. What's going to have to happen for this chart to reverse and start working to the downside? So a couple of things here. First of all, if we kind of zoom in on this, we can see that we've had, after this very volatile sideways period that we've had for about the last year and a half or so, that we've seen a pretty significant breakout and a move to a much quieter, less volatile market. Now this to me shows that it could be moving into what's called quiet and trending. Now, as you'll see, if this truly is quiet and trending, what it's going to have to do is it's going to have to move into volatile and sideways before it does move into a down move. Okay, so you can see an example of this from last summer. From last summer, we had a very quiet market, and then what happened was, as we got into the end of May, started to get more volatile. And this is where we got the release to the downside. So typically you'll see markets start to get more volatile as they approach a significant move to the downside. So a good example of this goes back to 2011, where we can see this period here where we had very quiet and trending market behavior to the upside. Look at how benign and docile the price behavior was, just kind of oscillating for a while, breaking out, stair-stepping higher, things like this. Just very, very quiet behavior, oppressively pressing to the upside. And then we started to see some instability move into the marketplace. And what is especially notable here is that not only was this a lower high on the daily chart, but you should consider this to be a lower high versus this high on the weekly chart. So we had a fractal reversal right here before we started to move heavily lower in early August. So again, this pattern follows all the time. Once a market is in quiet and trending behavior, typically does not just reverse outright like this. It doesn't just move down from the highs unless there's some kind of exogenous event which comes out of left field, such as some kind of disaster which is not priced into the market. What starts to happen is it starts to become unhinged and more volatile, more unstable before it finally starts to let loose to the downside. And if we go back to the financial crisis, so if we go back 10 years ago, we saw very benign price behavior. This is definitely quiet and trending. Even when we did have corrective price behavior, it was still very quiet back then. And this rally that we had in between 2006 2007 was just sort of, you can see how this one released quickly, but still all this did was create a higher low. So this is actually a fairly famous move that occurred back in February of 2007, where we dropped 50 points in a day. So from this very, very quiet behavior, this was a real shock to the system. But you can see as we go back to this point that this is over here, that this was very quickly erased. So all this did was provide a buying opportunity from a quiet and trending market. So this could be one illustration of what we could see, something like this. I mean, this was a real shock back then, but shocks are typically reversed to the upside if it's just a one-way shock in a quiet and trending market. So you can see what happened was this quiet and trending market, after this initial shock, started to get more volatile, started to get more unstable, and started to transition into a primary downtrend with lower highs and lower lows all the way through here until we finally did massively release to the downside. So this is what I will typically see, is that markets will go from quiet and trending to then starting to get more volatile, louder, and more unstable before it finally does release, regardless of the time frame. So this is obviously a larger time frame pattern that caused the top back in 2006, 2007, actually 2007, 2008, right? And then we have a smaller version of this that occurred back here in 2011, at the early 2011, where this quiet move started to get more volatile before it released to the downside. And then we have more examples of this more recently, where we started to kick into more volatility back here at the bottom of 2014, based on this was the Ebola sell-off here, which got reversed. And this quiet volatility started to give way to more volatility and released a couple of times. And what we've seen since then, especially the Brexit low, has been a move into very, very quiet volatility. And so right now, I'd say the damage is going to be limited. If we do see a sell-off here, it's going to be limited to something just a probe, perhaps down to 2100 or so. But I think that's going to be the extent of it. This to me seems more like what we saw at the very beginning of 2007. And if a 50-day handle comes along and scares everybody half to death, but this is a very similar type of environment to what we saw back then. So if anything is going to start to move to the downside, I think it's going to be short and over with fairly soon, and probably will lead to a slingshot move to higher highs in the near term. Yeah, I know that's probably going against the public opinion right now that thinks that the S&P should be closer to 600 and not 2200. But again, I'm just calling it based on what I see with the price on the screen and not somebody else's opinion. Now you're going to see us talk about more long Vegas spreads here in the near future because of this quiet and trending market. And calendar spreads is one way to be able to play this. So something that we've talked about lately has been identifying when stocks are at a point of resistance at exhaustion. So I'm seeing, in this case, like Alibaba, go into an exhaustion mode after earnings, so obviously gapped up after earnings, and is sitting there right below the $100 price level. So sometimes stocks can view these $100 or round number resistance as kind of a psychological objective to get up and over. And so in that case, maybe we have a few days where the price is just going to consolidate and try to work off this exhaustion down here from this extremely linear move to the upside. If so, the calendar spread is an excellent candidate for something like that if it qualifies for that type of trade. So for this type of trade, an example of this would be going over to the option chain and setting up a simulated trade here. So if we think that the price is going to stay around 97 or so, what we could do is set up, what I usually like to do is set up a put calendar spread if I have an overall positive bias to the trade, so that if it does continue to go higher, then it keeps the calendar spread out of the money. So what we need to make sure is that when we look at the implied volatility of what we sell, which in this case has only got about 10 days left, and then we buy something on the back month, so it's got usually about another month or so. What we might want to make sure is that there's not too huge of a differential between what we're selling and what we're buying. Typically, if we're doing these on the spiders or the IWM, we're going to normally find that the back month is going to be a little bit higher. We want to make sure that it's not too big a differential between the back and the front on here. And also what we want to make sure is that we don't have some kind of risk event happening within the span of the near-term option, which is going to artificially raise this implied volatility. And we might be stepping into a risk event that we're not aware of. So we need to make sure that we truly qualify that and we don't have any events coming up in the near future to deal with like that. So this is what the trade looks like. And again, the edge that we're using here is that when we have a market that typically goes straight up like this and bonks its head on a resistance point, typically what it's going to do is just going to consolidate within a small little flag pattern for the next few days. And usually with a trade like this, with an option that maybe has 9 or 10 days left to live, if we're selling that option, that time decay for that front week option occurs very rapidly, while the back week, or back month in this case option, is going to delay that decay for another 30 days or so. So we're going to see this differential between what we've sold and what we've bought occur very quickly. Of course, what we don't want to do is to have the volatility take off. It's like any other non-directional trade, whether it's an iron butterfly or iron condor or some other type of trade like that, which is a non-directional trade, we don't want much movement here. So we have to do the best job that we can to qualify that the setup is there, and then we have to look for the options as well too. So I would anticipate that going forward, we're going to be looking at more of these long vega. These are long vega trades, and this is very important for these times where we have very, very low implied volatility. So this is going to give us a little bit of an edge, especially if things start to melt to the downside. This can also be an effective replacement for the iron condor, which now is a very poor candidate with today's implied volatility down in the gutter. So that's it for today's report. Thanks for listening, folks. We'll see you tomorrow.